Welcome to our second quarter video update for the year 2021. Today, I have with me Glenn Murray, Chief Investment Officer and President of Capstone Asset Management, as well as my fellow portfolio manager on the private wealth team, Janet Kinsing. Welcome to both of you.
Hi, Murray.
And Janet, I think you're kicking us off with our first question to Glenn, so over to you.
Great. Thank you, Maria. So Glenn, it does appear that there is a light at the end of the tunnel. I guess there's always been a light at the end of the tunnel, but we are getting closer and restrictions are beginning to lift across the country. It seems like Canada is leading the way in terms of GDP growth, beating estimates, with future forecasts even being revised upwards in light of this, no pun intended. So what are your thoughts on Canada's economic recovery?
Thanks, Janet. I guess I don't fully agree with that outlook on the Canadian economy, as I continue to be cautious about the economic sustainability of some of these headline numbers that are being reported. So I do believe that 2021 will show strong economic growth, although I don't see Canada leading the way. However, I think it is imperative that we understand what the impact is of having a low 2020 base level for those economic numbers versus the result of a healthy growing economy. Much of the stimulus in Canada has not been of the nature that I believe was an investment into areas that generate lasting economic growth and development. That doesn't mean that all the stimulus was unnecessary, particularly in face of so much uncertainty caused by the pandemic. But I'm concerned for what underpins this expected growth in the medium term. For example, the unemployment level in Canada at the end of June is 7.8%. versus 5.6% in February 2020. The participation rate is also worse at 64.6% versus 65.5%, and has again been declining since March. We also have 1.6 million unemployed persons, which is over 500,000 more unemployed people today than at the start of the pandemic. When we couple that with the levels of wage growth we see, I remain uncertain about the health of the employment picture in Canada and subsequently the strength of the recovery, particularly once the government removes its support. According to the OECD, which is the Organization for Economic Cooperation and Development, it is still subsidizing, it being the government obviously, still subsidizing 14.2% of the Canadian workforce through its emergency wage subsidy program. As I mentioned, we are expecting strong relative GDP numbers for Canada and the US, but more recently we are seeing projections being revised lower for 2021. The OECD is projecting that Canada will regain its pre-pandemic level of GDP per capita around mid-2022. In the US, where GDP forecasts for the second quarter is still going to be good, the forecasts have declined significantly from where they were as recently as May, and we are seeing now third and fourth quarter forecasts being reduced also. To further support this perspective, we're now seeing the quarter two economic numbers and indicators are starting to show weakness. Now, this isn't completely unexpected with the renewed shutdowns we had during the quarter, but they shouldn't be ignored as meaningless. The second quarter has seen the bond market reverse after a strong run-up in interest rates during the first part of 2021. In the first quarter, it was claimed that the bond market was rallying due to the strong expectations of coming inflation and economic growth. Today, as it retreats from the highs, we must at least question if it is now suggesting something different. This pullback could now be indicating economic growth, inflation, and the pandemic may not be what the first quarter suggested. Commodity pricing, which also was a first quarter performance driver due to the expectations around reopening and inflation, has also been reversing recently. Lumber was one of the public high flyers at the start of 2021, but now has decreased 65% from its recent high. Additionally, items such as wheat, corn, and soybeans are also in correction territory. A few other quick examples of US economic data that's coming out. Core retail sales in April were down 0.4%, in May down 0.7%, and look like could be down again in June. Order sales were down 8.7% in May and 10.3% in June. and new home sales were down 7.8% in April and 5.9% in May. So overall, I remain cautious about the strength of the economic recovery and the return of inflation. I think it continues to be too early to identify that the reopening is driving an economic boom and inflation, particularly in the face of some continued changes in indicators, the unemployment picture, and the limited wage growth. We continue to monitor the data to try to identify which way things are solidifying. However, from an investment perspective, there continues to be good opportunities, whatever the economic realities are for the Canadian and global economy.
Thanks, Glenn. So this has been a concern for many of our clients, and rightly so, over the past 18 months. And it's also been a topic that Janet and I saw discussed quite heavily at a recent virtual conference we attended, and that is inflation. We don't really need to get into a long debate over whether this inflation we're in right now is transitory or not, but Glenn, can you comment on how inflation affects or has affected our pooled funds, maybe with a focus on the mortgage pools specifically?
Definitely. Inflation seems to be a real hot topic these days, and for good reason too. It can be a little challenging to discuss the impact of inflation within a portfolio without discussing whether we believe it to be short-term or long-term in nature. However, based on the answer to the previous question, it's probably obvious I remain of the belief that it is short-term. It is, however, imperative to remain attentive to that data being released to ensure that there aren't any reasons for that position to change. Having said that, we didn't need to add any specific hedges for the potential of inflationary risk, as that portfolio is a balance between traditional and non-traditional assets, which, due to the nature of some of the investments, automatically provide some inflationary protection. Some of the examples of these investments in a non-traditional equity pool come from exposure to real estate. We have several investments in real properties that provide both the potential for value appreciation and rental income, both of which provide inflationary protection to the fund. Additionally, we have investments in development projects where we build and sell inventory simultaneously so that the sale price can be adjusted to both current market values and any increases to building costs. In our fixed income pool, our investment in farmland is another good example of an asset that is typically protected against inflation, both through the appreciation of land and the ability to adjust crop pricing. There are also investments in infrastructure projects that have contracted cash flows, and those often have integrated inflation adjustments. Finally, within the traditional part of our bond portfolio, we tend to have investments with a short duration compared to the broad market, which offers some protection as it is less sensitive to interest rate changes, which are directly impacted by inflation. Actually, the fixed income market is at risk to an increase in inflation due to the connection between interest rates and inflation. However, while the broad market was negative through the first half of the year, our fixed income pool, which is currently overweight non-traditional investments, has outperformed the bond market by 6.75%. You also mentioned the mortgage pool, which it does provide some insulation against inflationary pressures. So traditional mortgage rates on homes and offices are set based on the prevailing bond rate at the time. So as inflation rises, it causes a rise in bond prices, which subsequently will cause a change to the mortgage rates. This has obvious impacts to the borrower, but while the lender is able to take advantage at the time of mortgage issuance, they are exposed during the term of the mortgage should inflation continue to be a problem. For our mortgages, however, which we finance the construction and development market, the interest rate pricing is mainly based on the credit quality of the deal. We spoke a little bit about this last quarter, but really what we're looking for there are things like the strength of the borrower, the project, what's the exit strategy, how much collateral is involved, the phase, location of the project. So pricing based on credit worthiness and project quality adds an element of insulation against interest rate moves in the short run. But obviously, longer-term interest rate adjustments will contribute to repricing of the risk. But we have a short average maturity cycle on our financings, so that allows us the opportunity to adjust this as they mature. Overall, if an investor has a balanced portfolio of our funds, then they're positioned to navigate inflationary pressures that come along, whether they're transitory or not.
Thanks, Glenn. So bit of a change of pace here. There's been a certain momentum in the market so far in 2021, it seems. TSX is up quite strongly so far, and same could be said for S&P 500. How are we taking advantage of this momentum in the markets, or are we taking advantage of this momentum in the markets?
That's an interesting question. If you're looking at it from kind of the momentum perspective, as we really haven't been taking advantage of some of the specific factors driving the market today. What I mean by that is some of the factors that are driving the stock market in the early part of 2021 have not really been areas we have strategically focused on in our traditional fund. As an example, the inflationary trade included investing in commodities as they rallied in the first quarter. Our traditional portfolio does not have a significant exposure to either commodities or the energy markets. Additionally, some of the areas of opportunity that have been focused on through this reopening trade, such as travel, hospitality, entertainment, have also not been key focuses of our traditional equity fund. Although we are investing in what we see as a distressed market opportunity for aircraft in our private high income fund. But going into 2021, we spent time reviewing some of these aspects and determined that our allocations at the end of 2020 were appropriate for our views for 2021. This resulted in us continuing to allocate a significant portion of our portfolio beyond North America, with a concentration in Asia for this global portion of our portfolio. This global exposure, and in particular our investments in Japan, have performed very well, helping the fund to outperform our benchmark significantly, both on a year-to-date basis and for the last year. In fact, our one-year performance at the end of June was 56.73% versus 26.97% for our benchmark. And currently, our year-to-date performance is 16.91 versus 10.06 for the benchmark. The drivers behind the market performance have looked different for the different markets also. So the TSX has outperformed the MSCI, which happens to be our benchmark, and the S&P 500, as it has been strongly supported by its exposure to energy and commodities. So although markets are performing well, their reasons for why they're performing differ. Overall, our clients have benefited from the current asset allocation mix, and we continue to believe that a discipline associated with managing the asset mix around medium to long-term trends is more appropriate rather than chasing the short-term momentum.
So Glenn, what keeps you up at night? Basically, where do you still see risk?
Yeah, I don't think we can really speak about risk without mentioning the pandemic. There is a positive feeling, obviously, developing in Canada regarding the economy opening, people looking at vacations and travel. But the reality is there is still significant global uncertainty. Two factors raise concerns for me in this regard. Firstly, with the global numbers of unvaccinated people, the increased probability of variants is significant. Therefore, the increased risk of one of those being more dangerous cannot be ignored and should be considered as an ongoing factor of risk. Secondly, the pandemic uncertainty appears to be leading to all levels of government paralysis and decision-making. For the economy and marketplace, this decision uncertainty and lack of a coherent plan increases risk. The other area of risk I will mention is my concern about the level of debt that Canada has taken on at all levels. The risk to the Canadian economy's ability to grow with the debt burden undertaken is unclear. The risk can impact future investment returns, among other things, if and when the stimulus is removed. In fact, the White House economists appear to be indicating in their own 2020 budget forecast a growth of approximately 1.9% a year for the last 8 years of their projections. This is after an initial growth bump generated by Biden's initial spending plan. In other words, spend now, bring forward future growth. Can we really expect anything different in Canada? So at this point, neither of those items exist in my areas of control or influence. So it's imperative that we operate with an awareness of where risks exist and plan accordingly to mitigate them as best we can.
So looking forward now, and I know in the past we've spoken about opportunities in the form of private equity. So what other opportunities are we looking at either within the funds or perhaps new funds? Could you provide us with an update on that front?
Yeah, I think I've spoken previously about how we look at different pool strategies as either core or satellite. To expand on this, the traditional equity pool, non-traditional equity pool, and fixed income pool really provide a broad, balanced approach to the traditional and non-traditional markets within a portfolio. The mortgage pools and private high income pool allow the investor to better align their portfolio to their desired risk and performance targets. This is what we would define as the satellite strategies. So it's within these satellite strategies that we continue to work on new options that we believe complement what we already have and will allow greater customizations for our clients. We are just finalizing a structure that we believe will allow clients to enter the U.S. real estate development market directly. This will provide a way to further align our client's portfolio with their risk profile while introducing a strategy with a higher return potential. For our non-traditional equity pool, we are just completing an investment into a development property in Nevada using this new structure. It's this structure that on future similar investments will allow clients to co-invest with the fund to gain exposure to specific investment opportunities that we have approved for the fund. And by doing so, will allow increased portfolio customization for our clients. Lastly, we continue to look to invest in the impact market space and look to capitalize on Capstone's experience in non-traditional assets. We've made a few impact investments within our current funds, but are focused on how we can be more actively engaged moving forward and have an initial focus for this in the renewable energy space.
Thank you, Glenn, again, for taking the time to share your thoughts with us. And we appreciate the thought and time that goes into you being able to join us today.
Thank you so much, Glenn. As we return to some sense of normalcy, office-wise, we don't really know what the future of these updates will look like, but it has been a great benefit for us to have you join us. And just a reminder to our viewers that should you wish to find out about any of the opportunities that were discussed, please be in touch with us by phone or by email. Bye.
Bye.